Welcome to a crucial discussion that could fundamentally change your investment journey. Today, we are tackling the most overlooked yet vital aspect of investing: risk management. This isn't just another financial concept, it is your ultimate survival tool in the volatile world of markets. Many new investors focus solely on finding the next big stock or the fastest way to make a profit. However, without a solid understanding of risk management, even the best stock picks can lead to significant losses. Neglecting this fundamental principle is a primary reason why many aspiring investors fail to achieve their long-term financial goals. Beginner investors often fixate on potential profits, dreaming of quick gains and exponential returns. In stark contrast, professional investors prioritize survival above all else. Their primary concern is protecting their capital, understanding that profits naturally follow sound risk practices. A single bad trade or an unexpected market downturn can swiftly erase months or even years of hard-earned gains. Without proper risk management, your portfolio is exposed to unnecessary dangers. Think of risk management as the essential seatbelt for your investment portfolio, designed to protect you when the unexpected happens. At its core, risk management in investing is the systematic process of identifying potential losses before they occur. It involves understanding the various risks inherent in financial markets and developing strategies to mitigate them. This proactive approach helps you navigate uncertainty with greater confidence. The process extends to controlling potential losses across your entire portfolio. It also means setting clear limits on the potential loss you are willing to accept on any single investment. This disciplined approach ensures that no one trade can disproportionately harm your overall financial health. Ignoring risk management is perhaps the most common and detrimental mistake made by new investors. This oversight often stems from a lack of awareness or an overabundance of optimism. However, it consistently leads to predictable and painful outcomes. One significant error is putting all your eggs in one basket, such as investing your entire capital into a single stock. This lack of diversification exposes you to immense concentrated risk. If that one company falters, your entire investment could be wiped out. Another frequent mistake is neglecting to use stop-loss orders. These are preset instructions to sell an investment if its price drops to a certain level. Without them, you risk holding onto a losing position indefinitely, hoping for a recovery that may never come. Furthermore, letting emotions like fear and greed dictate investment decisions is a recipe for disaster. Fear can cause you to sell at the bottom, while greed can lead you to hold onto a winning position for too long, only to see it turn into a loss. These common pitfalls are precisely why many beginners struggle to build sustainable wealth. Now, let's discuss actionable rules that can help you effectively manage risk and protect your capital. These are not mere suggestions. They are fundamental principles that seasoned investors live by. Implementing these rules will provide concrete steps to safeguard your investments. First, embrace the 1% rule. This principle dictates that you should never risk more than 1% of your total investment portfolio on a single trade. For example, if you have a $10,000 portfolio, your maximum loss on any one trade should not exceed $100. This rule ensures that no single bad trade can significantly impair your capital, allowing you to absorb losses and continue investing. Second, practice diversification across sectors and asset classes. Do not concentrate all your investments in one industry or type of asset. Spreading your investments across different areas such as technology, healthcare, real estate, and bonds reduces the impact of a downturn in any single sector. Diversification is about reducing specific risk, ensuring that your entire portfolio isn't reliant on the performance of just one or two investments. Third, consistently use stop-loss orders. Before you even enter a trade, decide on your exit point if the investment moves against you. A stop-loss order automatically sells your position when it reaches a predetermined price, limiting your potential downside. This removes emotion from the selling decision and protects your capital from spiraling losses. Fourth, always consider the risk-reward ratio before making an investment. This ratio compares the potential profit you expect to gain from a trade against the potential loss you are willing to risk. A favorable risk-reward ratio means your potential gain significantly outweighs your potential loss. For instance, risking $10 to potentially gain $20 or $30 is a good ratio, indicating that the potential reward justifies the risk taken. Aim for ratios of at least 1.2 or 1.3, meaning you stand to gain at least twice or three times what you risk. These practical rules provide a robust framework for protecting your capital. They are designed to help you navigate market volatility and minimize the impact of inevitable losing trades. By adhering to these guidelines, you build a resilient investment strategy. Investing is not about winning every single trade. That is an unrealistic and unsustainable goal. Even the most successful investors experience losses. The true goal of investing is to stay in the game long enough for the power of compounding to work its magic. Professional investors understand that losses are a part of the process. Their success comes not from avoiding losses entirely, but from their disciplined approach to risk management. They limit their losses on individual trades, allowing their winning trades to generate overall profitability. This disciplined behavior is what sets them apart. This crucial distinction separates gamblers from true investors. Gamblers chase big wins and often risk everything on a single bet. Investors, on the other hand, prioritize capital preservation and consistent, sustainable growth through calculated risk. Adopting this mindset is paramount for long-term success. In summary, risk management is not an optional add-on to your investment strategy. It is the foundational pillar upon which all successful investing is built. Your primary focus should always be on protecting your capital first. Once your capital is secure, profits will naturally follow. Embrace the principles we've discussed today: the 1% rule, diversification, stop-loss orders, and favorable risk-reward ratios. These tools will empower you to invest with greater confidence and discipline. They are your shield against market uncertainty. If you found this information valuable, please give this video a like. It helps us reach more beginner investors who need this vital knowledge. Also, consider subscribing to our channel for more educational content designed to help you succeed in your financial journey. Thank you for watching, and remember, protect your capital and the profits will follow.